Welcome to Security Showdown. Now, my name's Ken Finnan, and I'm happy to be on here again. Tonight, we're pitting two giants of the investing world against each other. Mutual funds versus ETFs. One's old school and proud of it. The other's lean, mean, modern, and ready to take over. Join us are Sarah, the ETF evangelist and the queen of efficiency, and Mark, defender of the faith mutual funds and their so-called personal touch. Buckle up. It's about to get heated. Even I don't believe this crap. Oh, the hot mic crap. Never mind. Sarah, you got 30 seconds. Why are ETFs superior?
Because ETFs are efficient, low cost, and transparent. Mutual funds are the dinosaurs of investing, overpriced and overmanaged. Why pay a fund manager to try and fail to beat the market when ETFs track the index for a fraction of the cost?
Dinosaurs, come on. ETFs are just knockoffs, cheap copies of real investing strategies. Mutual funds deliver active management with teams of experts who adapt to market conditions. ETFs don't have the strategy, they just follow the herd. Real investors know the value of professional management.
Professional management? You mean professional underperformance, right? Face it, Mark. Most mutual funds can't even keep up with the market. Investors are waking up and ditching your overhyped sales pitch.
Keep telling yourself that, Sarah. Meanwhile, mutual funds provide real diversification and careful stock selection, not just a cookie-cutter index. If you want quality, you pay for it. ETFs are just a discount shopping like TJ Maxx. If you're making money, it's because you're lucky. Okay, Mark, why should investors pay higher fees for mutual funds when ETFs are so much cheaper? Because you get what you pay for, Ken. Mutual fund fees pay for research, stock picking, and risk management. ETFs are cheap for a reason. They don't do anything. You're just buying an index and hoping for the best.
Yeah, and my clients are paying a fraction of what your clients pay for hope. Mutual funds love to tack on 12B1 fees, sales loads, and hidden costs. You say those fees pay for research? Funny, because most of that money goes to marketing and sales commissions. At least with ETFs, the costs are transparent and minimal.
And ETFs are completely free of costs, right? Wrong. Bid-ask spreads, commissions, markup, markdown, tracking errors, they add up fast, especially for active traders. Mutual funds have no trading costs and no intraday volatility. Stability matters, Sarah. The only thing you're paying is a sales charge up front. Oh, an ETF.
Stability?
Yeah, okay.
Please.
You're going to be a commission
more like stagnation.
Out, right?
Your no trading cost argument is just code for we don't give investors control.
With
ETFs let you decide when and how to trade. Mutual funds trap you with arbitrary end-of-day pricing. It's like watching a show on Netflix and not getting to change the channel until 4 p.m.
And if you have a lot of money, you can reduce what goes in. If you do B shares, say you want to do a B share instead, you go, I'm going to be a long time, but I don't have a lot of money. So you can put it in. You pay no sales charge up front. And when you leave, the longer you stay, the lower it gets. So we're definitely suitable for a lot of different people. And if you're going to be in there for a short time, do C shares. If you're in there for 2-3 years, you pay no sales charge at all. Come on. Mutual funds are way better. Okay, Sarah, give us a real world example where ETFs outshine mutual funds.
Easy. Say you're saving for retirement and want exposure to the S&P 500. Instead of paying a 1% management fee for a mutual fund that probably underperforms the index, you buy an ETF like the SPY, low cost, simple, and you get market returns. No gimmicks, no surprises, just performance.
And let's say you want something more strategic, like a fund targeting undervalued stocks in an emerging market. A mutual fund with active management can find hidden gems and capitalize on opportunities that passive ETFs are going to miss. Your precious SPY can't do that, Sarah.
Hidden gems? More like hidden risks. Emerging market funds are notorious for high fees and underperformance. With ETFs, you get diversified exposure without paying for someone to guess wrong. Let's not forget the tax benefits. ETFs rarely distribute capital gains, while your mutual funds are busy blindfolding investors with surprise tax bills. And let's not forget ETFs are at the mercy of market trends. If the index tanks, so does your precious SPY. Mutual funds professional management, they actively manage risk to protect the investors during downturns. We're the smarter choice for long-term stability. Mark, we know taxes are a big deal. How do mutual funds justify their capital gains distributions and all those taxable distributions every year? Because they're part of an active strategy to maximize returns. When we sell a stock for a profit, it benefits all the fund's investors. Yes, there's a tax hit, but it's a small price to pay for active management. ETFs dodge taxes because they don't do anything. Small price to pay? Spoken like someone who's never seen a mutual fund tax bill. ETFs use an efficient creation redemption process that minimizes taxable events. Investors keep more of their money instead of handing it over to Uncle Sam because their fund manager felt like rebalancing, and most of it ends up being long-term capital gains, which is a lower rate anyway.
And that's because ETFs don't actually manage risk or adjust to market conditions. Passive investing is lazy investing. Mutual funds put in the work, and yes, sometimes that means taxes. At least we're delivering value, not just tracking trends. Why is your fund type the better choice for investors, Sarah?
Because ETFs are efficient, flexible, and designed for the modern investor. Mutual funds are stuck in the past, charging high fees for mediocre returns. Choose ETFs if you actually want your money to work for you, not your fund manager's vacation fund.
And choose mutual funds if you want real management, risk control, and access to specialized strategies. ETFs are for people who think investing should be cheap and easy. Mutual funds are the people who want it done right.
Done right? You mean done expensively. Keep selling that snake oil, Mark. The rest of us are moving on to the 21st century.
And the rest of us will enjoy real growth while your ETFs follow the market off a cliff. Have fun being average, Sarah. And that's a wrap. ETFs bring low cost, transparency, and tax efficiency to the table, while mutual funds promise active management, stability, and expertise. It's a clash of innovation versus tradition, efficiency versus strategy. Thanks to Sarah and Mark for the fireworks. Join us next time on Security Showdown, where the debates are as hot as your portfolio should be.